Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Seems like it's been a very long week for some reason. Don't know why, but glad. Oh, I know why. Because the relief after tax time. If you're like me, you're on the permanent extension program. I never have all my stuff together by the end of April. I'm doing too many things. But anyway, as the man said, this is the Bullington Capital Report here every Saturday morning from 11 to noon on 1420. We're also on iTunes under the Bullington Capital Report. So if you wanted to download this as a podcast, that's kind of fun. It's available all over the world now and kind of interesting. If you'd like to call us, the number is 216-901-0945. This is a call-in program. You can call in and ask questions related to investing, personal finance. We'll do the best to answer to the best of our ability. And a little bit later in today's program, I'm actually going to answer a question that was submitted through email. And I thought it was a great question. I think it's particularly pertinent to conditions that exist today, which really aren't bad. We're going to spend a lot of time talking about that too. And current conditions, where opportunities are, because I think there are some pretty big opportunities out there. It's not bad. Certain areas you probably want to stay away from. In fact, the areas that have done the best over the past couple of years, now they're looking a little long in the tooth. In other words, their valuations are slightly higher than they probably should be, and not grossly higher though. That's the good news. It's not like you're going to get a big crash or anything like that. Barring some type of a major political event that happens worldwide, you can try to predict those. That's incredibly difficult to do. But anyway, so all other things being equal, things are relatively good right now. I think there are a lot of opportunities and a lot of stocks that just haven't participated in the rallies that the market's put in over the past couple of years. I mean, literally, it's actually going almost on 3 years now. Markets have made a little bit of progress in 3 years, not a ton. In fact, if I look at the New York Composite Index, that's the all the stocks that trade on the New York Stock Exchange, it's only up 8.7% in 3 years. It's almost 4 years now. That's not a huge return. The S&P 500 has done significantly better than that, but that's the index that has the overpriced stocks in it. So, I don't know. It could be okay. It's up 24% over that same time period. Plus, you'd have your dividends, so you're really closer to 28%. That's a huge gap. That's a huge gap. And that's what you find when you're looking at the market cap weighted versus the other types of indices. In fact, let's see here. If I just took the equal weight's actually done just as well, which is kind of surprising, actually. The past 2 years, it hasn't done anywhere near as well. Past 2 years, the equal weight index only up about 8% over that 2-year time period. And let me go back to the S&P, and it's up closer to a little over 13. So you're looking at a fairly big gap in the equal weight versus the market cap weight over the past couple of months. And if that doesn't mean anything to you, don't worry about it. We've got a workshop coming up where I'm going to explain that concept in detail, because this is also, again, it's the opportunities are where those things that haven't kept up should actually start to close that gap at some point in time, because of the way that those funds are structured. And over long time periods, it's I think it's just a much better way to invest. And this goes right along with the topic that we're going to be talking about. choosing an investment strategy that suits you. Investing is a big deal. It's a really big deal. It's what's going to allow you to retire at some point in time, and without, hopefully without reducing your lifestyle to a point that you would not like to have in your old age. They used to call it the golden years, and hopefully, a little work, a little effort, we can get that done. But it's not easy, and one of the biggest challenges is getting the actual knowledge of how markets work, how they really work. Like what I was just saying, the difference between an equal weight and a market cap weighted index over the past 2.5 years, you would look at it and go, oh, obviously the market cap weighted weight is the way to go. And then you look over the past 10 years and you're going, hey, wait a minute, maybe the equal cap weighted is the way to invest my money. And in the long run, I would say I would stress the equal weight over market cap weight. In the long run, there are some other ways of weighting the stocks in your mutual funds that you need to know about. And I guess I'm beating around the path here. What I really want to talk about is how do you value a stock? If you don't know how to do a basic valuation, we're going to cover that at the workshop because this is incredibly important. If you don't know how to do a basic valuation, I'm going to teach you in 15 minutes. And you'll be able to do an excellent job of valuing a company, and it'll make you the envy of a lot of professional investors who also know what I'm going to talk about, but are afraid to speak. They're afraid to speak in such simple language. So simple, why can't I say it? No, it actually is. And I'll give you an example. Let's say you were interested in investing in Facebook, for example. And Facebook's been a wonderful performing stock. It's up significantly since it came public. Facebook had $27 billion worth of revenue in the last 12 months. It was up 50% over the prior year. The growth rate, last quarter it was up 50%. That's pretty amazing to have revenue growth of 50%. Is the company's stock, by the way, is worth $416 billion, and the profits that they had were a little over $10 billion. Now, last time I looked, if you put $416 billion in a 10-year treasury at 2.5%, you made the same income that somebody that owned all of Facebook would have made, except that yours was guaranteed. Facebook has to go out and do that again. You've got to sell $27 billion worth of stuff. They've got to maintain a profit margin of almost 50%, which is huge. To be able to maintain that, and the treasury is guaranteed. Big difference. And that's what I'm kind of talking about. And I like Facebook. I think Facebook's probably a good company. Is it a good investment? I'm not sold on that, not at these prices. At the price that it is today, that's a lot. They do have some cash, by the way. So the enterprise value, when you make adjustments for the stuff that if somebody were to buy the company, they're not going to pay the market cap, the value of the stock for Facebook. Well, actually they will, but they're going to get money back because they have some cash. So their net out-of-pocket expense would be $386 billion. And this is okay. That this has a lot of good news factored into it. So what I'm saying is Facebook is not underpriced. It's not underpriced. You're buying Facebook today, you're paying full price for it. Now, if it continues to grow at the same rate that it's growing at, phenomenal. Great. Okay. And if I saw Facebook as one of the top positions in a mutual fund that I was interested in investing in, I would say, okay, that's okay. There's still an awful lot of risk because I don't know if you remember MySpace before Facebook, but they're still out there. They're not making any money anymore. And that's my problem with paying full price for a company like Facebook. If you pay full price, those guys had better not miss. They're priced to perform extremely well. So it's not a huge bargain. And if I looked at, actually probably one of the better stocks to look at would be that company called Snap that just came public. And that, if you ask me, is significantly more difficult. You look at Snap, whose revenues, let me see here. Actually, I got to go back to that other page. By the way, the reason that you want to be able to do this, the reason that you want to be able to come up with a basic estimate of what a stock should be selling for under normal conditions is that when you're looking at a mutual fund and you see the performance of the mutual fund, that's the first thing that most people look at. And actually, there are two things your average investor looks at. The average investor looks at cost and performance. Now, the average investor doesn't realize that the cost is already factored into the performance. That's why they're looking at it, because if they knew that, they'd save themselves half the effort and just look at the performance. So that's the first thing. If you look at the performance, it's got the costs in a mutual fund. It's got the cost factored in. But more importantly than performance, how is the fund making the money? What is it investing in? How does it invest? Okay, that's a little management discussion. And every one of the annual reports of a mutual fund, because a mutual fund, did you know, is a C corporation? A mutual fund is actually an investment management company. It's a C corporation. They have a board of directors, just like every other C corporation. That's publicly traded, and they're all supposed to, by the way. But so they've got a board of directors. It's a C corporation, and it's managed by a portfolio manager. The lead portfolio manager, typically what you'd equate to as a CEO. These guys go out and they tell you what they're going to do with the money. In the prospectus, they tell you what they're going to try to do with the money. Then you can actually pull up the holdings on those companies. I've got Morningstar. It's got the top holdings. Actually, it's got almost all the holdings in, I forget how many thousands of funds there are, but there are thousands. Every fund that most people have heard of is in there. And the ones that aren't in there are in my Bloomberg database anyway. And you can pull up the holdings in there. So you're looking at the performance, and that's an okay place to start. But you want to take a step further and look to find out how they've performed. Why have they done well? And that'll show up in the stocks that they own. So what do I mean by that? Well, if you've got some fund managers that have big positions in, say, I don't know, Twitter, in Snap, in companies like that, if they made money, it's not typically because of the skill of the investment management team. It's normally luck. And if you keep pushing your luck like that, sooner or later, it pushes back. That's my point. You're going to be a good, solid investor. You want to learn about investing, selecting money managers. You need to first have the basis for telling for being able to evaluate whether a stock is overpriced or not, so that when you look at the top holdings in your fund, if you see companies that don't have sales or profits, or if you see companies whose share prices are pricing in perfection, which means that they have to be nearly perfect to justify what it's selling for, if you can't figure that out on your own, you are always at the mercy of people who are selling product. You're always going to be at the mercy of people who are selling product. That's another thing I'd like to point out, just spend a minute or two here. Bullington Capital Management, we're registered investment advisors. We've always had to abide by the fiduciary standards, which means we have to put our clients' interest ahead of our own. In fact, the way that I set up my business was so that if I do something and it hurts you, it hurts me too. That's it. So our interests are perfectly aligned. Now, there's an awful lot of paperwork being generated by a new Department of Labor rule that's forcing almost everybody to do it now. Yeah, which is kind of interesting because I took that oath, that's why I left the brokerage business, to be able to come out and do the things I felt like were going to be in my clients' best interests and to align my interest with theirs. If it hurts you, it hurts me. It's the way it should be. Benefits you, benefits me too, which is the way it should be. And there are going to be some changes coming on. We'll talk a little bit more about that stuff after the commercial break, which is coming up in a couple minutes here. But I just wanted to let everybody know it's not that difficult. You can ballpark what a company should be selling for without having to spend a tremendous amount of time. And for those instances when you do have to spend a tremendous amount of time, it's typically because a business is very large and has a whole bunch of subsidiaries that aren't in closely related industries, like Berkshire Hathaway, for example. That's hard. That's really hard. And you're going to spend some time working on that. So, and I would say, you know what? Leave that to the professionals. Yeah. If you see a bunch of names like that in the top holdings in your mutual fund, there are still some things that you can do. Doing the valuations work still works on those companies, by the way, but they become a lot less predictable. So the more complicated a business is, the more unpredictable its future outcome is. You get a business, if you're on a website of a business that you're doing some research on, and you've been there for 5 minutes and you still can't kind of figure out what they're doing to make money, that happens a lot. Then I would say skip that stock. Go on to one that's not quite as complicated. I got to take a real quick phone call. I'll see if I can cram it in before this commercial break. I got Jared. Jared, do you have a question for me?
Yes, I do, Bill. Say, I wanted to get your thoughts on someone who has a pretty large chunk of money sitting in cash and he wants to get into the market. Would you advise dumping it all in at one time or average it in over a period of time?
That's a good question, and it's going to basically be luck. So if you average it in, let's say you average it in over a year or two, and the market's in a rally mode, so you're paying higher and higher prices each time, and then as soon as you get fully invested, the market corrects. You're going to have really crappy performance.
Mm-hmm.
Does that make sense?
Yeah, it does. I mean, I guess there's really no ideal time to invest in unless you're right at the bottom, which is, who's going to be able to predict that?
Right, exactly. So here's what I typically recommend. You go with an allocation. Okay, so whatever your allocation is going to be, you start off and you do that right off the bat and you get ready to adjust. So you get ready to adjust. So let's say your allocation happens to be 60% stock, 40% or 30% bonds, and 10% fixed income or cash equivalents. That's what your allocation is going to be. Market has a big correction. Okay, your 60% is now only 50% of the total. You would end up taking money out of the bonds, moving it over into stocks to be able to take advantage of those lower prices. So see, it's not important that you know what the market does. It's important that you know what you're going to do in response. If you want to hang on for a second, I got to take a quick commercial break. You listen to Bill Bullington right here on 1420 The Answer. Stay tuned. Money! And we're back. Hey, Jared, you still there?
Yeah, I'm still there, Bill.
Okay. So did I get your question answered for you?
Yeah, you did. I have one other question real quick, somewhat related. The reason I asked you this is because I'm thinking of getting more heavily invested in the market, but I'm a little concerned that we're a little overdue for a correction, and I just wanted to know if you expect a correction this year. I know you can't predict the future, but just given how far we've come and how long we've been going at this rate, do you expect a significant downturn sometime in 2017?
Well, and that's funny because you started that question saying, I know you can't do this, but actually nobody knows that. Nobody really knows that. And if the stock market worked on a calendar, this would be a lot easier. And I really wish it would work on a calendar. That would make my life 10 times easier. But valuations are not too bad. If you get away from the super large cap stocks, especially the stocks that have done the best over the past 2-3 years, are they overdue? I don't know. They're ahead of themselves. They're selling at prices they probably shouldn't be selling at, but not by a lot. So does the money stop? And this is what you would hope would happen. Does the money stop going into those stocks and start going into a lot of the stocks which have not participated in this rally over the past 2 to 3 years? Because there are a ton of them. that have not participated in this. So that's what we're looking at. And if you're a long-term investor, then you're extremely pleased with that, and you find a strategy that will try to take advantage of that. And they're going to be more value-oriented, by the way. That'll be a more value-oriented strategy. So if you're looking at active managers, there are lots of good ones out there. In fact, we're part of what I have to do over the next 12 months to comply with a new Department of Labor rule is I have to add more categories to the portfolios that I'm investing my clients' money in. And it's not that I'm being given a choice. It's you either so you either do or die. So I'll be doing the same types of things that you're looking at. So I'm going to have to get outside of my own area of expertise, but I'll find the managers who are doing the things that they should be doing. And that's what gives me comfort. So when I go into a company, a mutual fund that I'm thinking of investing in, or a strategy that I'm thinking of investing in, what I want to find out is, what are they doing with the money? Do they pay attention to valuations? Now, what they say they do and what they're doing can often be two different things. So you have to look it up. It's like Ronald Reagan said, trust but verify. So you pull up the fund, you pull up the top 10 holdings, and I can show you how to evaluate those top 10 holdings in less than an hour. That's what we're going to be talking about at that workshop, is how do you know fund managers are doing what they tell you they're doing? And that's a big deal, because there have been a lot of mutual funds coming. I just looked this up the other day. The average life of a mutual fund is 15 years. That's the average life. Now, that's including those that have been around for 40, 50, 60 years. So when you look at the, probably there's a mean, which is the average, the median, that's the number right in the middle, and then the mode, the number that comes up most often. My guess is that the mode is somewhere around 5 or 6 years, because I've got 30 years experience in the industry now, and I've been watching this go on for a long time. So a fund will come out, just like all these, right now the hot thing is the funds with low betas, high alphas, and all that kind of stuff. It's all statistical stuff. And what Warren Buffett had to say about that a long time ago was that, there are a lot of investment managers running around with PhDs who are nothing more than witch doctors with PhDs in computers.
Yeah.
And so that makes it complicated. That makes it really hard. And it sounds good. It sounds really good on paper. And a lot of those funds won't be here 4 or 5 years from now, but don't fear, because they'll resurface under a different name and they will do the same thing. So that's just part of the industry. They're a large part of selling mutual funds is marketing. And a lot of the firms have figured out what you want to hear. So they'll come out with a fund and tell you what you want to hear. Here's our, dividend fund. These stocks have raised dividends every year for the past 20 years. Great. That'll work until it lags the market for 2 or 3 years. The assets flow out of the fund, and they'll shut it down and open up a new one. So that's why it's really important for you to be able to kind of know what the fund managers are doing, to try to figure out how sustainable that might actually be. Now, there are no guarantees that you're going to be able to do that, because I've seen a lot of fund managers who did very well for an extremely long time period, for some reason, just lost their minds. That happens too. That's why you don't want to put all of your money in one strategy or one fund. You want to have a mixture out there. And if you do, you've got enough tools now where you look up the top 10 holdings, you see what they're doing, you can read the management's discussion, and you can get a pretty good idea of whether or not those guys were just lucky or whether they were skilled. It doesn't mean that
Gotcha.
So anyway, sorry about the long.
Okay, Bill.
Yeah, I appreciate you calling in.
Oh, thank you, Bill. Thank you.
Yep. Have a good day. Bye-bye. And somebody had written a question I thought was good enough to be able to read on the radio. Here we go. I'll just read it straight as I got it. Bill, I wonder if you might spend some time explaining when, if ever, and how, what weight, other considerations we should give in spending an analytical time studying for the purpose of investing stocks that have no current earnings, stocks that haven't had earnings for 2 or 3 years, stocks that have never had earnings. would our intention to trade rather than invest, because there's a big difference between those two words, make the approach different? The answer to that question is yes. It makes a big difference. I ask this since for years you have admonished us not to spend time examining stocks with no earnings. That's on the investment side. And he put in parentheses, perhaps the caution limited to not investing in no earning stocks, which is absolutely right. Good observation. Yet some of the stocks you have referred to have no or minuscule earnings. Moreover, several high-flying popular stocks, Tesla, biotech, have no earnings. That's my question. So basically what he's saying is, if I'm investing, would I invest in stocks with no earnings? It depends. Typically, I will not. If the company has cash flow, if they're able to pay their bills, and I like the company and I understand the business, then I would invest in that company. That is not a trade. A trade is different. That's like it's like doctors. One's an ear, nose, and throat specialist, and one's a podiatrist. Okay, they're both doctors, different specialties. Trading and investing are two distinct, different activities. They're both related to the stock market. In fact, they both involve stocks, but they are different. So from a trade, if I really liked the company, if I saw the trend and I know how that works, I would say, okay, it's okay to trade a stock that doesn't have earnings. It makes me uncomfortable, by the way, because I started off in this industry as an investor. And I still do a lot of investing. But I learned to trade, basically trend following. I don't do day trading or anything super short term like that. But I've learned the trend following method, which, by the way, there's a website on called Look Out for the Bull where I teach that method. And I like that method. It's got its challenges. The same way investing has its challenges. And I'm going to take 5 minutes because realistically, I guess I've been doing this too long, because to me, it's not very difficult anymore to distinguish between a trade and an investment. For other people, I know it can be. In fact, it was never all that difficult for me. There are two different mindsets. Actually, almost have to have multiple personalities to pull that off. So it helps if you've played Division I football in your lifetime and got your head banged around a little bit. Yeah, I'm just kidding. Kind of. But realistically, there are two different activities. They are closely related because they all involve stocks. But if you're an investor, and I'll give you an example. So let's see. J.C. Penney, for example. They're losing money. They haven't had earnings for a while. They have a lot of sales. They also have debt. They actually have a fairly significant amount of debt. And I've been in and out of calls on the stock, and I think I still own a little bit of the stock. I don't own a lot of it because they're losing money. But J.C. Penney has a ton of sales. In fact, I take it back. They just recently were cash flow positive. I don't know if it actually translated into earnings. You'd have to go back and double check that. But here's my thought. A company that's got $12 billion in sales has an awful big base to work from. So as an investor, if you take $12 billion in sales and let's say they can eke out a 2.5% profit, that's a lot of dough. That's a lot of money. You can translate that into earnings per share and then divide that by 5% or multiply it by 20, which either way you want to do that. That stock could be selling up in the high teens, low 20s. And it's right around $6. And I've increased and decreased my position in it over the past couple of years. If they do end up getting into really big trouble and going away the way that most of the headlines, by the way, and this is a good hint for you, read the most negative headlines you can find to go look for bargains. So when they're bashing retail, the way that all the big publications online and magazines have been doing over the past 6 months, popular thing to do, that's where you want to go look if you're an investor. You want to go to look where people are afraid, where they're afraid to go, because when fear enters the equation, people have a tendency to make bad decisions and they tend to panic. But you got to be careful. Okay? Don't buy in companies that have a lot of debt. Try to buy companies who are cash flow positive. Try to buy companies or invest in companies who have a lot of sales. Because if you've got a lot of sales, you've got the ability to cut back on your costs. If you don't have sales, and you've got a large amount of costs, that's really risky. And see, that's what I'm talking about. When you're trying to find this strategy that suits you as an investor, thing we'll be talking about at the upcoming seminar. You can go to my website, bullingtoncapital.com, to find out when you're trying to find out what you are as an investor, you need to know how to place a value on a stock, and you also need to know how long a stock can stay away from its fair market value that you might estimate. The method I use is super simple. In fact, they teach it in a couple of professional programs. They use a lot of 3 and 4 syllable words. I'm going to show you how to cut through that quickly. And boy, I just lost my whole train of thought there. That's what you get for trying to think of too many things at once. But anyway, so if you want to be a good investor, you got to figure out what kind of investor you are. Some people are trend followers. Some people are long-term investors. Some people like to buy stuff and hang on to it for years. Some people like to buy stuff that's undervalued. When it gets to be fully valued, they let it go. That's my favorite. One of my favorite ways to do it. They all have their challenges. We'll talk about those, show you what they are. I'll show you funds that do that. Maybe, now that I'm thinking about it, I can even pull up a prospectus and show you what the management's discussion is, and then show you how to look up the top 10 holdings there and evaluate that, because these are the things you need to do as an investor. If you want to be an above average investor, I should say. An above average investor does exactly what I'm talking about doing, whether it's your financial advisor or if it's you. Somebody needs to be doing this homework. Somebody needs to know why you're doing what you're doing, because when you're underperforming the market, and all strategies underperform the market from time to time, they all do. And they'll do it for a long enough time period at some point in time to discourage you significantly. Maybe even get you to do the wrong things because you're not really familiar with what's going on in your portfolios. You need to be a little bit involved there, even if it's just to have somebody explain it to you. And hopefully they're able to do it in relatively simple language. So you kind of go, oh yeah, that makes sense. Yeah. And I'll be using my the Y charts, the subscription I have. I have the expensive one. I know I've talked about this before. And there've been some changes there. They've got some different types of programs that you can use. I really like their service. The retail service is not as expensive. I think it's about $50 a month. You can't do all the screening that I do, but you can actually pull up the companies, which is really what you want to do anyway. This is a great way, by the way, that I'm about to give you to look for stocks. Go into Barron's or the Wall Street Journal. When you find something that you think is interesting, then you want to find out what the firm's sales are. You want to find out what the firm's enterprise value is. That's the cost of buying the entire business. That's the type of thing that Warren Buffett looks at. He wants to know, if I buy this business, how much am I going to really be paying for this? I'm going to have to buy all the stock, and I'm going to have to pay the debt off, and I'll get back any assets that company owns. So if I add all that stuff up together, what's my true cost? And they refer to that as enterprise value. So what's my true cost of buying this business? And if I buy this business, what am I going to get? How much cash is this company generating? That's what I'm interested in. And you can actually take a formula I'm going to give out at the workshop, and you can figure out just how attractive these companies might be. Now, we talked about KCG. It used to be Night Trading. Then they got bought out by somebody else. Now they got bought out again. The symbol was KCG. And you can go back in the radio programs in the files and hear when we talked about that. That stock has been unbelievably volatile. Okay, well, they just got bought out, and that turned out to be a fairly profitable transaction for most people that have been listening to this program. I'm hoping that Discover Financial Services actually turns out very similarly somewhere over the next couple of years or so. Yeah, I'm willing to give it that length of time because these are investments. When I talked about the KCG, that was an investment. By the way, it did come up on one of the trend following scans. Came up on there more than once. We'll talk a little bit about how that happens right after this commercial break. Listen to Bill Bullington right here on 1420 The Answer. Stay tuned. And we are back. Hey, if you'd like to call in, 216-901-0945, 216-901-0945. We got about 15 minutes left on today's show. Thanks for listening. If you are listening, if you want to pick it up online, you can get it at the Bullington Capital. You can get the Bullington Capital Report on Apple iTunes, or you can go to my website, or you can go to The Fish. The Fish is hosting it as a podcast. So 955 The Fish. Actually, you can just Google that because I forgot what the actual website is. So, but that's what happens when you talk too fast and think too fast. Those thoughts tend to collide once in a while. I'm sure anybody over the age of 50 knows what that's like. So anyway, we're talking about workshop coming up. How do you figure out whether a mutual fund can replicate its performance in the future, or if they just got lucky? Well, there are no guarantees that you're going to be able to do that, by the way. So, but all other things being equal, you'd still like to know how to evaluate a money manager or a strategy, because it's very important. The strategy is what produces the long-term returns. How do you know when a money manager is actually sticking to the strategy? And that's happened to me so many times, I don't even like to think about it, where a money manager said they were going to do this, and then they ended up doing something else. That oftentimes that shows up in the prospectus. And if they're doing something, and if they're doing something, and you're able to double check, if you're able to check up on the strategy itself, then you know whether or not it was just bad luck, or whether the manager was doing something maybe they shouldn't have been doing. And that's a big help in trying to improve your investment performance. I got to go to the phones right now. I've got Daryl. Daryl, how you doing?
Good morning. Do you feel as well as you sound?
Well, other than the fact that I hyperextended my right knee and I'm wearing a brace, I guess so. No,
I was in the urgent care last week for my knee also.
Oh, man.
I fell on it, and it turns out that I'm prone to gout crystals. So it's a good thing I got all my nutrition products.
Yeah. Yeah,
so,
for sure.
I wanted to thank you for taking such good care of my retirement fund.
Oh, well, I'm trying.
And I appreciate it. And I was wondering if I might be able to put in a shameless plug for your favorite cleaning product / water surfactant product.
Yeah, that's in fact, I just ordered another bottle of that stuff. That thing is, that's quite amazing, actually. I really love that product. It's, and by the way, it's a lot cheaper when you're a member. I was looking at the online, I didn't realize that. I didn't look at that tells you how much time I've had to actually analyze this. But
yep.
So the bottle that we just bought was a lot less than it was when I was not a member. And I'll just tell, everybody has different ideas about this, but this is a Shackley's product, and it's a really good product. Pardon me?
Don't say that name.
Oh, you're not allowed to?
Well, yeah, they don't want it publicly. Anyhow, people can find out about it at Nutriskis.com.
Yeah, and
they can buy it there, and they can get the member price by registering. Nutriskis.com, Nutriskis.com.
That sounds good. That's the.
We'll make sure that you get your little.
Oh no,
for that.
Yeah, I wouldn't worry about it. You can put that right under your name. I just signed up to get the discounts. Anyway, at some point in time, hopefully, maybe we'll get a marketing program for it, because it is a very good product, and I'm kind of anal about the my kitchen cabinets, especially the new ones I got, because I've had a flood. I had an insurance thing come in. I had to get an entirely new kitchen because a water pipe broke, and it was bad. So anyway, these new countertops, I thought, I know what I'm going to do. I'm going to get this granite that's got some brown, some black, some yellow, some gold, some white. Now, I think those are the colors I'm seeing. I'm partially colorblind. So anyway, now that I got this really cool granite countertop, I can't tell whether or not it's dirty. I have to feel the countertop. So I'm using the cleaner on it. I just wet it down with that, wipe it off, and we're good to go. Then I can feel again, and there's nothing.
Most most people would really love to have a countertop that you couldn't tell was dirty. My wife managed to pick black.
Oh.
And
yeah.
every time I get up in the morning and the sun's shining in the window, I can see every speck of dust on it. It drives me crazy.
Yeah. Yeah, I know. That's funny. Well, you need to use that H2 on it.
Yeah. Good old basic H.
Yep.
Yeah.
Works very well. So, well, hey, thanks for calling. Nutriskis.
Yeah, I appreciate that.
Yep. Nutriskis.com.
And there's a link on there to shop, and they can figure it all out for themselves.
That sounds good.
Well, thanks so much for the shameless.
No problem. When it's a good product, people need to know about it. So, all right. Have a good weekend.
Thanks, buddy.
Yep. Bye-bye.
You too. God bless. Bye.
And I guess we've got a few minutes here left. 216-901-0945, 216-901-0945. And I like to talk about when I've had good products. By the way, there was a commercial I heard that I didn't sell on my show for a home advisor, and I've used those guys too. And that actually, I had good experience there. So I don't know if you have or not, but you need something, some work around the house done. I've had very good experience using that home advisor. So I love to tell people about things that I've used that have gone well for me. And by the way, I'm not one of those kinds of people who goes out and tells 10 people when things go bad. If you ask me, I'll let you know. But boy, when something's done very well, I love to let other people know about that. And there is a really good product. We'll talk more about it on future shows. And I do have the Look Out for the Bull. I should mention, since it is up and it is running. That's the trend following thing. And I got to tell you guys, trend following is very cyclical. It is extremely cyclical, which means that it'll go for some time without working very well. So is value investing. Value investing can be very cyclical. Those are the two major styles, okay, on the opposite ends of the spectrum. And then there are shades of those two in between there, and there are an infinite number of shades. But you've got value on one end, trend following, aggressive growth on the other end, and you've got a whole bunch of stuff in the middle. And we're going to be talking about both of those strategies because those are the two basic strategies. Everything else is a blend of those two. And there are only a handful of strategies, incidentally, of investing in stocks that work really well. And then there are thousands of shades or variations because, these companies, the fund companies are in business to attract new assets. So they're doing a lot of marketing. They're creating stuff out there. And what's really funny about it is there really isn't that much difference between a lot of these funds. The difference is in the description. It's not in what they're doing. So if you learn this stuff, you save yourself an enormous amount of effort. When you're reading through the prospectus, you can look at the holdings and go, oh, yeah, I get that. All right, I understand that one. And you can also find out when a fund manager's been really lucky, because the really lucky ones are generally the ones at the top of the list, the ones that show the best 1 year, 3 year, 5 year performance. That's because they caught a trend and whatever they were investing in went way up over the past 12 months or so. It made their 3 and 5 year numbers look really good. And if you knew how to do what I do, you would know how to avoid those funds. In fact, a large part of investing profitably in the long run is knowing what to avoid in the short run. Yeah, it's nice when those stocks with no earnings or sales are going up really fast and they go up several 100%. Not as nice when they open up 80% lower than they closed the night before. That's pretty. So you want to try to avoid that if at all possible. You got funds that have really good track records. You look at the stocks in those funds and they're a little overvalued. Then you may not want to abandon the fund, but you might not want to add to it. Or you may want to cut back on that and add to some things that haven't done as well over the past couple of years, but also have good strategies, because that happens. And that's, I guess, one of the things that is really difficult is when all you have access to are the performance numbers and the fees. That's incomplete data. You do not know what you need to know to be able to make good investment decisions. And it would be lovely if that were true. That would mean I could actually do something different with my life. I mean, I like what I do. But if it were true that all you needed to know was the track record and the fees, then everybody would get the same returns. We'd all just invest in the very best performing funds, and life would be nice, and that would be the end of it. Yeah, unfortunately, that's not actually how it works. You have to know some things. You don't have to know nearly as much as you'll hear on a lot of television shows, radio shows, Wall Street Journal, a lot of the publications out there. They talk about a lot of stuff that's basically meaningless. But they have to talk about something because they have to sell ads. So that's what you get a lot. You get them talking about something because they have to sell ads. So if you really want to improve your ability to weather the storms in investing, because oftentimes, I'm telling you, it's not easy. I've invested in MLPs over the past couple of years. They're just now getting back, just back to where they were when a lot of people made the investments. So, but the good news is they still have decent dividends. The bad news is there aren't very many IRAs that'll let you invest in them anymore. That's another part of that. Well, that's not the Department of Labor. That's something entirely different. But we'll talk about that on future shows. And I got about 10 seconds here. I want to thank everybody who's listened today. You can actually catch this on my website, bullingtoncapital.com, or in Apple iTunes, or 955 The Fish's website. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.